Hi, good afternoon, and welcome to Stonehearth Capital Management's quarterly update webinar series, CIO's Corner, with our Chief Investment Officer, Chris Gauthier. I'm Amanda Sylvia, and I'm the Senior Client Service Associate for SCM, and I'm really happy to be here assisting Chris today. I would like to start off with just a few housekeeping items. Please use the Q&A button at the bottom of your Zoom window to submit any questions that you may have throughout the course of the webinar. I will go ahead and ask Chris to answer as many as he can at the end of the webinar. If we do happen to run low on time and we do not get to your question, Chris or myself will reach out to you at the end of the webinar to make sure that we do get your questions answered. I'm really excited to introduce our speaker today. Chris is Stonehearth's Chief Investment Officer. He brings more than 20 years of investment management experience to our firm, working with both institutional and individual investors. He is responsible for setting our firm's overall investment policy and strategy, including directing our asset allocation, investment risk, research, and portfolio management functions. Chris, thank you so much for speaking with us today.
Thank you, Amanda, and good afternoon to everyone. Coming here from new office digs at 100 Conifer Hill. Still the same town, Danvers, just moved to upgrade the office a little bit to move across town. And as you can tell, I'm battling a little bit of a cold here, so I apologize for that. So with that, let's jump right in. We got a lot to cover this quarter. And what we're going to go through today is we'll go through asset class performance. And what we'll see is that, while strong in the short term, there was still a lot of work left to be done over the longer term performance numbers. We'll look at the current investment environment, and we'll use our multiple lens approach, looking at it through valuation, macroeconomic data, technical data, and qualitative data. To end, we'll with how we position the portfolio in this current investment environment and some final thoughts, then really followed by any questions you may have. So with that, let's jump into the quarter performance. And as we can start, the start to 2023 was a very good start to the year. And despite the surrounding chaos, right? You had bank failures, ever-changing expectation from investors on inflation, you had rate hikes by the Fed again. All that being said, it was a very good quarter for both equity and fixed income. They posted very strong returns. If you look at the best performing asset class in the quarter, all the way over to the left in light blue or anything in the U.S. equity markets, you see the NASDAQ really, was the best. And that's kind of filled up with those tech, large cap growth stocks, and they led the way. But we also saw some strong performance from international stocks, and those are represented here in anything that's green. You can see international developed at up almost 9%. Think Europe, think France. But emerging markets, think India or China, also had a pretty decent quarter, up almost 4%. Even in the U.S., and again, like we said, that's that light blue, the U.S. small cap was up almost 2.5%, and they were hurt a lot by the bank crisis since they're overweight those banks, and they still managed to post a very decent return. In fixed income world, which is represented in anything with a purple bar, you saw duration over credit, and you kind of measure duration by the treasury, right? Because there's no credit risk in treasuries. Well, we don't think there's any credit risk. Of course, we'll find out in a few months. But for right now, there's no credit risk in U.S. treasuries. So when they was outperformed, you can kind of say duration is outperforming, which we saw. And that really was due to investors really positioning themselves for potential rate cuts. And as we'll see further along in the presentation, I don't want to give away too much, but maybe a little bit misguided by investors there. We don't think rate cuts are in the cards for 2023, given the data we're seeing. What's left over is what we call alternatives. So it's what it said, it's anything left over after we get through the equity and fixed income markets. You can see gold was the best performer in that asset class, up almost 8%, great quarter. Again, really does well when there's a whole bunch of chaos and banking crises out there. That helps. But in general, alternative asset classes were very weak. Saw oil down over 1%. Commodities in general, which expands to natural gas, some of the soft grains and things like that. Some of the industrial metals were the worst performing asset class, down 6.3%. So like we always like to do here at Stonehearth, I have a caveat with this performance. Equity was positive, especially when we look at the NASDAQ in the US, but it was really driven just by a handful of stocks. And what we're looking at here is the S&P 500. And on the left-hand side, you can see the weight of all the constituents in the indices. There's 503 of them as of the quarter end. The top 20 represent about 30% of the total weight in the index. And when we follow those lines over to the right-hand side, we start looking at performance and the contribution of those companies. And you can see those same top 20, representing 30% of the index, returned 7%. That represents over 93% of the total return for the S&P for the first quarter. So again, you never want to turn your back on, really strong performance, but you can see that, we'd really like to see this expand the breadth a little bit and have those other 71%, start posting those strong returns too. So again, good quarter, but just something to keep an eye on. We really want to see that breadth expand before we get too excited about the US equity market. Now, extending the time period to the past 12 months, we get a slightly different picture. First thing jumps off the page at everybody, it should be, is that they're all mostly negative, right? We just saw everything almost positive. Longer term, it's still negative. Start with fixed income, again, in purple. We see, like, unlike the past quarter, credit was higher over duration. We see credit with the high yield bond, US ag bond, corporate bond, still negative, down 6%, but much better than that duration asset. Long-term treasuries at 17%, and it was by a wide margin. Saw some nice price protection in munis and short-term treasuries that actually managed to post some positive returns, given what the Fed was doing with rates. When we think about risk assets, again, US equity assets are in blue, international assets are in green, negative across the board, led by the NASDAQ, just like is almost a direct exact opposite of what we saw in the quarter, to the downside. International and the defensive Dow indices really provided the most protection. Still negative, but at least gave a little bit less downside in the marketplace. So again, let me look at the alternatives. You see gold still in the lead, well, trailing US dollar, but good performance of 1.5%. You see the dollar up almost 7% over the past year. So compared where we were last time we met in January, improvement from last time we spoke, definitely. But we still have a long ways to go to recover a lot of that performance we lost in 2022. So that's kind of where we've been. Now we kind of want to look at, where we are, and then we can kind of talk about where we may be going. So let's take a look at the current market environment and what is and will drive the price action of the market going forward. In our mindset is the Fed, right? And this is what we're looking at. The Fed is we're looking at the Fed funds rate, which is set by the Federal Reserve Board going back to 1990. That's that brown line right here. See that going back until we get to the current, which is 4.88. And we use that weird number because the Fed changed their mandate because I guess they were bored one day, had nothing else to do, and came up with a study and said they wanted to give a range. So instead of saying the Fed funds is 475, they say it's anywhere between 475 and 5. So that 488 represents the middle. So that's where they are right now. And we fully expect this afternoon, right around 2 o'clock, they're going to move that to a range of 5 to 5.25. And they've been pretty consistent saying that. So that's where we get to now. But what's really interesting about this chart is where we're going. And those are those dotted lines. When we look at the blue lines, these are year-end estimates. So when you see that 5.110, that's the end of 2023. You can see that's what the Fed said the Fed funds are going to be. Again, counts for another 25 basis points, and then maybe a pause to see what happens and see the lag effects of that. When you look at what the market expects, that's that green line. You can see that difference, right? Investors continue to disbelieve the Fed as they expect rate cuts this year, right? They see rates down to almost 4.35 by the end of the year. This expectations divergence, main driver, one of the positive performance you saw in the quarter, but really the performance we've been seeing over the past year. Every time those investors don't believe the Fed and they lower their projections, you see the market rally. When they come to their senses, in our mind anyways, and think, okay, the Fed's actually really going to do what they say they're going to do, and their expectations creep up towards where the Fed is, you see the kind of market sell off, and you get that trading range we've been into, and we've talked about with a lot of our clients who's kind of stuck in this trading range. So, we fall into the camp where, don't fight the Fed. It's one of our mandates here. And we do believe at this time you should not be prudent to fight the Fed. But again, it's just us saying this. There is data to support why we think the Fed's going to keep hiking and stay higher for longer than the market expects. And when we look at the Fed, you're all aware they have a dual mandate, right? So their job is a dual mandate. The first piece of that is price stability. How do they define price stability? Well, it's defined by, according to the Fed, an inflation rate of 2. Why 2? Your guess is as good as mine. They probably had a committee, did some studies, but again, there's no data, no studies to prove that 2 is better than 3, that 3 is better than 4, that 2 is better than 1. That's arbitrarily what they came up with. That's what they say their goal is, to get inflation down to 2. So that's the first part of the mandate. The second part of the mandate is just as squishy. It's called full employment. We don't have that defined. We do have better data on this, and historically thought to be right around 3%. It doesn't get to zero because it's just structural friction within the labor market. You can never get down to zero. So anytime we see something around 3%, economists say the market's at full employment. So look at the Fed. They need to get inflation down and price stability, and they define that as 2. And as long as they keep employment at full employment, then they're fulfilling their mandate. So let's look at those 2. And we'll look at price first. On price, when we talk about price, we talk about inflation. We talk about inflation, we talk about that CPI, Consumer Price Index. It measures prices year over year, and things like that. So what we're looking at here is 2 different measures. We're looking at headline, which is the blue line, right? That's everything. Then we look at core. And what core does is excludes food and energy, and the Fed likes to look at core. It doesn't make a lot of sense to me, because I don't know anybody, when they're trying to judge the price people are paying, can exclude food and energy from their budgets. It just, doesn't pass the smell test to me. But neither here nor there, they want to look at this. Both are telling the same story, that they saw the big rise up after COVID, almost 9% on the headline, a little bit over 7% on the core, and we're seeing good, strong improvement since then. But we have a long way to go. We just mentioned, right? The Fed's mandate, the Fed's goal is 2%. Right now, the core is at 5.5%, right? So a long way to go. And anybody who's been in business, who's worked in the real world, know that when you set out to accomplish something, those easy stuff gets done first, right? And the Fed took care of that easy stuff. So now you're kind of stuck with that hard, sticky, only equivalent rent, real estate that takes a lot longer to come down. So long way to go on the price stability mandate. The other half of the mandate, right, is full employment. And you can see from this chart here that, we're there, right? And that's that unemployment rate, which is in that brown line. You can see as of February, it's 3.6%. So give or take, we're right at that 3%. We have what economists call full employment in the marketplace. So as long as they don't blow the market up, and that's the labor market, by raising rates, because they need to get that inflation down, they're all set and they're fulfilling their mandate. The other line here is wage growth. That's that blue line. And you can see that very healthy at 5.3%. So again, this is almost offsetting their inflation fighting tactics, right? If wage growth is higher, it means you have more money in your pocket, which means you tend to spend more. As you spend more, prices increase, and you get higher CPI and higher inflation, and it goes against what the Fed's trying to do and bring that down. So as long as the labor market's strong, you can see where those are kind of conflicting with each other. But again, when we look at the prices, they're there. When we look at the employment, they're there. Now, what we get a lot of pushback from clients is, and people in the marketplace, is that wage growth and unemployment rate is looking in the rearview mirror, right? This is what we made. This is what the unemployment rate was. What's it going to be in a month from now, 2 months from now, even 4 months from now, 4 months from now? This doesn't give a lot of insight into future health of the labor market. But there are data points out there that you can supplement with that actually give you, we believe, insight into where the labor market's going. And we have 3 of them on this next slide. So looking over the first, on the left-hand side, we have job openings, right? There are a lot of job openings. It's screaming at you. Compared to history, it may be off the recent record high, but there's a lot of job openings. If you want a job, there's pretty much a job out there for you to get. So again, this tells you that going forward, that the labor market could continue to be strong. And the most important data point to me when we look at this chart is the quits. That's that top right-hand chart. Again, like every data point you're going to see here, it's kind of coming off its record highs, but still quite strong compared to history. And I like this one the most because just think about yourself, right? Do you quit a job if you feel you can't get another one? If there's a weak job market, you don't. You quit when there's a strong job market, when you already have a job. So as long as those quits stay high, then people are perceiving that the market's strong. And again, that's a forward looking. They don't look backwards and say, okay, if I quit a job, I'm looking backwards. You're looking forwards. So you can see that really points to a strong labor market. And then the latest boogeyman you hear all the time is layoffs. That's that bottom right-hand side. And again, you hear Amazon laying off, Google laying off. And I know being laid off is, very cruel and very hard to do and very hard to deal with. And it's a very major impact to that person being laid off. When we look at the aggregate number in the economy, and that's what we're looking at here, you can see that's a very small piece, and it doesn't feel small to that person who doesn't have a job anymore. But when looking at the economic impact, you can see from that lower right-hand side that it doesn't make up a big part of the labor force, and it's still at almost record lows. So again, all these are looking at a very strong, healthy labor market. So one thing, so before we go on that, we look at this, right? So you have inflation numbers still way too high, strength in the labor market. You can see why the data and the weight of the evidence in my mind is pointing for the Fed to keep rates higher for longer than the market expects. One thing that could change this, the inflation employment picture, is a recession. And on that front, the data is mixed a little bit. We're looking right here at the PMI surveys, and there are surveys, they're a diffusion index, and there's a company out there, ISM, that calls up a whole bunch of companies, same ones, every month. And they basically ask a series of questions. And the questions have a multiple choice answer. You can say they're either getting better, staying the same, or getting worse. And what to say is, in terms of hiring, you're going to hire more, hire the same, hire less. And you can see how that folks down to all these different categories, and you get a diffusion index. And when the reading is above 50, we say the economy is expanding. When below 50, it's contracting. Very good. And forward looking. And you can see here, there's disconnect, like we're showing, that you're seeing that it's just mixed data. That green line is manufacturing, right? The manufacturing economy down at 46, heading lower. Doesn't seem like it's bottoming it out at all. So that's really pointing to a contracting economy. You look at the red line, and that's the services piece of the economy, which is a different part of the economy. You can see that that's showing expansion, right? Again, so you get similar data points telling you different stories, and that would say the data is mixed in terms of that. You know, and one data point that's not mixed, had no qualms, is confident, that screaming recession at the top of its lungs, is the slope of the yield curve, right? And all we're looking at here is the difference between a 10-year rate and a 2-year rate, which is the red line, right? You know, so what can you earn on income from investing in a 10-year treasury compared to a 2-year treasury? And then we have in the green, we have 10 and 3-month, and in blue and 30 and 10. So basically just comparing a longer rate to a shorter rate. And when we see that negative, it's usually a sign that something's wrong. And the best way to explain it is, if you think about when a loved one has a cold, or it's not feeling well, one of the first questions you ask are, do you have a fever? And you measure that fever to see if they have a temperature. And if they do, you know something's wrong. That's what the slope of the yield curve is. It's the fever. When it's negative, it's not right. Something is off in the economy. And it makes sense, right? Because if you're lending money, just say to the federal government here, if you're lending the money for 10 years or 2, you would expect you want a higher rate if you're lending for 10 years. 1, inflation. 2, just the risk, right? It's that much longer. You would expect that. When that's not right, and we see with the inverted yield curve, it usually indicates that a recession is in the cards, slower growth of 6 to 12 months out from when we've seen this. So again, we're still in the time frame when we could still see this recession. It has a very good hit rate, and we'll see how this plays out once the data comes in. So looking at all this, you know, the weight of the evidence is mixed, but definitely leans towards a potential recession as we look out in 2023 and 2024. But the question always is, what's priced in and into the equity markets? So let's look at the equity markets and what they're telling us from the price standpoint. And we look at the equity markets, we usually start with valuation. We're big believers in valuation here. And we look at the S&P 500 as a proxy. We're looking at the forward PE ratio. What is a PE ratio? It's just price over earnings. In layman's term, what does it mean? It's what how much investors are willing to pay for $1 of earnings. And that's all it is. And we can see throughout time that it varies, but the average is 16.8. So you can say that when it's above that average, it's probably expensive. When it's below that average, it's probably cheap. And you can see the standard deviations, so you can identify those extreme moves. So when looking at it, what's it telling us? Well, we're not at extreme, right? We're below that one standard deviation, but definitely not cheap and a little bit elevated. And when we look at other different valuation measures, the CAPE, which is just a longer PE, dividend yield, how much money they're giving back, price to book, price to cash flow, all telling a similar story. Elevated, but not at those extreme levels. So this is just the S&P. So when we have the ability to expand our view beyond the S&P, you can clearly see some differences in relative value. We're looking at the similar data points just in a table rather than a chart. You can see the PE, you see price to book, price to sale, same data points looked at earlier for the S&P, just expanding it to different parts of the equity market. And you can see it's broken out by US on the top, international on the bottom. You can see S&P small cap 600, those are small cap stocks. Russell 1000 value, those are what we consider value stocks. Then you see the broad-based EFA Europe EM and some major countries in the international. And you can see at first glance that there are pockets that have some valuation support. You can see in green that small cap 600 compared to itself and also compared to the rest of the equity market looks pretty attractive from a valuation standpoint. We move to the international space, you can see that there's some attractiveness there. It doesn't have to be green, those are just the top three. Even if it's not green, you can say it's still being attractive relative to itself and relative to the equity market. And we focus so much on these valuations, and it does not the entire picture, but because again, like we've talked about, overvaluation is not typically the cause of a bubble bursting, and stocks can definitely stay expensive. We've seen it for like a long time, but over the longer term, the returns you might expect to get from investing in equities tend to be smaller when you buy stocks at higher valuations than when you buy them when they are cheap. So if you have the ability to buy equity like returns at lower valuations, you want to enter that into your investment process and take advantage of that. And that's what we're doing with our asset allocation here. So that's kind of how we looked at the equity market. Now we're going to turn to the fixed income market, and begins with the shape of the yield curve. So again, this is similar to the inverted yield curve we saw. We're just expanding the horizon and looking at the actual rates at individual time periods. So what this top chart is showing you is that what the government can borrow money at for different years. And we look at the current one at 331, which is that blue line. And if you look at this one right here, just to show, you can see the 2 year, the government can borrow money at 4. When we look at the beginning of the year, it was 4.4. So rates at the 2 year came down, and they actually really plummeted. That's a big move for rates here. So we can see the yield curve is inverted. We could also see, those short-term rates are really moved much different than the longer-term rates. Longer-term rates fell in the quarter. Shorter-term rates went up. You expect the shorter-term rates to go up as the Fed's raising rates. So you can see that inversion. And when you can see, start thinking about the shape of the curve, you can see that it's flat, right? It kind of flattened out in the quarter. You hear a lot of talking heads say it flattened, and that's what you can see here. That's moving downwards and to the right. So that's all good and well, but what does that mean? Well, flat, and as curves moves flatter, historically has been an indication that bond investors, because that's who's setting these rates, actual bond investors, are really expecting low or negative growth in the future. So when looking at the shape of the yield curve and what it can tell us about expectations, you can see the growth expectations should be ratcheted down based on what the fixed income market is seeing. So again, that kind of leads to that weight of the evidence to maybe a recession is in the cards as we look out to 2023, 2024. Now, before we leave fixed income, there is a bright spot to the Fed. I know the Fed gets a lot of rhetoric from raising rates, but again, there is something that's good about raising rates, because for first time in a long time, right? Although they actually did it to themselves because they're the ones who lowered rates, but we finally have some income in fixed income markets. And what we're looking at here is going back over the past 10 years, different parts of the fixed income market over 10 years. So that's that brown bar. That's where rates have been, in their range. When we look at that purple bar, that's the average, right? You can see them depressed, right? It still shocks me that, high yield was down at, 6% to lend. But what the good point is, we look at those blue diamonds, that's the current, right? So you see how these rates have come up really based on the Fed just raising rates. It doesn't make fixed income super attractive, doesn't make them super cheap, but what it does is it gives you a little bit of cushion, some income buffer to handle the expected rate rise. So they're a little bit more attractive because you have a higher income buffer coming into your portfolio to protect you against some of that volatility. So for the first time in a while, fixed income is becoming a little bit more attractive because you can get some actual real income from them. So before we move on to our risk models, I want to touch on two significant events, one past and one potential future that could have long-lasting, or like you're going to see, maybe not long-lasting impact on the markets. So the first is the bank crisis, right? Why was it perceived as a crisis? It was really 3 small regional banks. The fourth one didn't really fail. JP Morgan is taking it over. So they're not really failing. Everything's going to be hunky-dory there. So why was this crisis? Why was everybody up in arms? In one word, contagion. You can see from this chart just how big and diverse the U.S. banking sector is. I mean, I never knew this until this crisis happened. We started looking at these numbers. So that bottom line, total banks under supervision. So there are 3,800 banks operating in the U.S. That's just astounds me, right? It's a huge number. No other country is even close to this number. So that's good and bad, right? Sheer number of banks help diversify risk, but also, and I think this is where that contagion comes in, adds to the complexity in regulating them. Where is the risk? Who has the interactions between banks? And we look at those regional bank organizations, it's not insignificant. It's 2.7. And if you don't know how they're interacting with their balance sheet, trying to find out all this data, you can see where the fear of contagion crept in. I do think the FDIC did a great job in containing that fire. So I don't think it expands much from here. And other than just having the protection, the banks are in a much better position, because when you hear contagion, everybody kind of flashes back to 08 and comes in everybody's minds. And we look at these bank tier capital one ratios, this amount of assets they have set aside for their risk. You can see that was really low in 08, right? They're back 10%. They're up here at 13.7%. So they're in a much better, safer position. So it doesn't mean they're immune from crises. It just means they can better handle crises. So again, we think they're in a much better position than 08. Also, another small side benefit of this is that it looks like the banks may be helping the Fed, right? And look on the right-hand side, this is banks tightening lending standards. So not only is this helping from their pulling back lending, so helping that risk ratio on the left-hand side, we're also limiting the supply of money out there. So there's less money to borrow, less money to spend. You get the picture, inflation may be coming down. So there is, maybe a bright spot by them limiting some of the lending they have out there. So that's really the bank crisis. And the second, and this is the latest boogeyman out there in the press, is the debt ceiling. So the debt ceiling, what is it? Well, it's an arbitrary rule made up by Congress that puts a cap on the amount of debt that can be issued by the government. You can see from the chart right here, right now, it's 31.4 trillion, and we're coming up on that. This really makes no sense, right? We have enough problems in this world without making them up out of thin air for ourselves, and that's what we're doing here. So when we look at the budget, they already voted on the budget. They already voted how much money to spend. They already agreed that we're going to spend this much money. This is just how we're going to pay for it. It's like going to the supermarket, buying groceries, writing a check, going home, then canceling a check, saying, I don't want to do it. I made a mistake. It doesn't make any sense. It's just causing a lot of problems. I mean, look back in history, you can see this isn't the first time they've done this, right? So it's not like there's a prior history. They know what happens here. And we can see, looking at that brown shaded area, that's the S&P 500, they have a lot of volatility. You've also, from prior episodes, I'm sure people remember a lot of scaremongering in the press, both sides, right? But in the end, like they always do, kick the can down the road, and we think their vote increased the limit. Because we've seen events can disrupt the market for a while, sometimes weeks, maybe months, but let's see here in history, it shows they don't have long-lasting impact on investors. So again, we think this gets resolved. And the next chart kind of shows the point of maximum scaremongering, right? And those are those pink dots. But I'm kind of a half glass full guy type of guy. And to me, that's when we can start seeing it die down in the press and move on to other more important things. But the first deadline, Janet Yellen came up with this the other day too, is this early June deadline when we cannot pay our bills. I do think all this does, it just gives a date for when they actually come to an agreement. And it may be a little bit longer than June, but in the end, they'll come to a resolution. And these are the dates you can watch where you can start to say bye-bye and look at the debt ceiling in the rearview mirror. So again, a lot of noise to be sure, but what we try to do always here at Stonehearth is find the signal from the noise, and the debt ceiling is going to be more noise than signal based on history. So let's turn to our risk modeling. What can it tell us about the future environment? For those of you joining our call for the first time, we use multiple models to kind of take the temperature of the investment environment, and really allows us to use a weight of the evidence approach to allocate risk in client portfolios. So the first one we're looking at here is a third-party model from Ned Davis Research. It has over 80 individual indicators rolled up into these four subcomponents right here: tape, which is just technical; sentiment, what investors think and believe about the markets; monetary, monetary conditions, are the easy; and combo is more international and price action. So again, when we looked at it compared to where we were last time we met, this was at a -2, and right now we're looking at as +1. So we saw improvement, right? And we've seen the price moved up. We saw some better price action across the board, and we saw some better investor sentiment. So he saw improvement. He's not positive yet, and one of his rules in his model is that once he goes negative, and you see he went negative back here in 2022, which was good call. We saw the market roll. He cannot go positive again until his model gets back to a +2 or above. So he's not there yet. So improvement for sure on his standpoint, but still pointing to a cautious stance as we look out to 2023. We also use our internal model really to complement and fill in the blanks from the Ned Davis research model, really valuation centric, and just a few things we think he's missing and really add to the robustness of our investment process. And look at here, we break it down to 3 different subsets: technical, valuation, and macro. And you can see when we last met 12/31/2022, when we met in January, but as of 12/31, it was a -7. And you see, as we're standing here right now, it's a -1. So again, we saw major improvement, just like he did, and maybe a little bit more improvement, but it really all came from that technical standpoint, right? Those technical pictures drove the entire improvement in risk. And you can see that we had a lot of kind of neutral readings, and now they're really turning positive with that great performance we saw in the first quarter. So again, like to see a more broad-based improvement, like we saw that chart, but you can't deny the data on the technical standpoint. It got a lot better in 2023, and we have become more constructive in our asset allocation based on this indicator data. Look at valuation. We saw no change, still negative across the board. We saw that in the PE ratios, saw that in the CAPE, earnings estimates, anything we look at, we really can't find anything to support the valuations right now. So we're negative across the board on that. Economic, mixed, right? It did come up by 1, but it's picking up those mixed signals from the economic data, through the weakening manufacturing data, positive jobs numbers. So again, it's mixed on the economic data. And we look at the qualitative, really no change. It's the Fed, and it's don't fight the Fed. And we believe the Fed's going to be higher for longer here, which is going to have a negative impact on the market. Putting that all together, you get to like a -1, which is where we are right now. So again, major improvements across the board, really driven by that technical, but still caution is warranted. So how does all this translate into our positioning here at Stonehearth Capital? So looking at asset allocation, and this is relative to one of our moderate benchmarks. So during the quarter, we did trim our underweight to equities on a more balanced outlook due to the improving data, especially that trend data we saw, but still cautious and remain underweight equities entirety. But within equities, we saw some pocket of better valuations. Remember, we saw that. Like the better valuation picture. We also saw some relative outperformance across the pond. So we went overweight international developed, think Europe, and we moved up to a market weight or neutral reading in emerging markets, really just based on valuation and improving performance. Fixed income land, remain overweight, with a larger allocation to credit. So, where you take risk matters, especially in fixed income. So we believe that by diversifying and going some other fixed income products, you can maintain your overweight, increase the income, despite the Fed raising rates. So again, we maintain our overweight in fixed income. Cash, remain overweight due to attractive yields, right? That short end of the curve, over 4.5% in income is pretty attractive. Also serving as risk control, because again, we did talk about being a little bit cautious in the marketplace, and does provide liquidity, right? Should a market opportunity arrive, we have a cash to invest in that opportunity. Speaking of opportunistic piece of the portfolio, we remain underweight. We still have a few plays we like. There's gold. Clean energy is another spot that we like. And for those who have potentially higher risk tolerance, an allocation to the beaten down banking sector really makes sense. But overall, we're just not finding enough opportunities to go overweight, let alone market weight in there. So we remain underweight opportunistic in our portfolios. So kind of summing up the final thoughts of what's kind of going on. So good start to the year, but still negative of the trailing 12 months, really stuck in this range bound market. Really seeing that disconnect between the Fed and investors on the path of interest rates is driving all the returns in every single financial market we're seeing. And with the data and the dual mandate, we see on one hand and not being successful in inflation, it's slowing, but still elevated, but offset the strength in the labor market. So that leads to don't fight the Fed. Rates will be higher for longer than the market expects. The Fed's telling you that. Seeing mixed economic data, strong consumer being offset by weak manufacturing. We saw that in the PMI surveys, right? That service data is more consumer orientated. Valuation pictures definitely improved, but still elevated, not at attractive levels. There are some positives to be had for rising rates, right? Income from bonds starting to look attractive again. And, kind of summing it all up, getting more constructive based on improving risk models, but really still lean defensive as we wait for stronger signals to emerge. So that kind of sums up my piece of the presentation. Now, I'd love to hear if you have any questions, concerns, or anything you want to talk about. So I'll turn it back over to Amanda.
Hi, Chris. Thank you so much for that. Just as a reminder to use the Q&A button right there at the bottom of your Zoom window to go ahead and enter in some of your questions. We do have a couple just to get started. Chris, how much would the market have to sell off before the Fed would lower rates?
Good question. I think they're really probably referring to that Fed put that's in the marketplace. We really don't think that's there anymore, right? And that was when the Fed kind of stepped in. Ben Bernanke had it, and really said when the market fell off, they stepped in and called that Fed put. We don't think that really exists anymore. When looking at the rates, looking at the dual mandate, I think they're really, sticking to that dual mandate. So to cut rates, they need to see inflation way below 2. But a pause, inflation with a 3. I think what would make them cut rates is really only 2. And the 2 puts left is the labor market, right? So if they saw a disconnect in the labor market, unemployment rate jumped up 5-6%, you can kind of see them get really scared and start thinking about cutting rates. And the other put, I think, for the rate cuts is credit liquidity. Now, this is not credit for everybody. This is for good, strong companies. Can they borrow money? Is it the credit market flowing backwards and forth throughout good, strong companies, not the zombie companies that can't borrow money? That's fine. So again, I think the put is not in the market. They'll let it fall. And they're really focused on the dual mandate and that credit liquidity. So as long as credit's flowing to good companies, and unemployment rate is below 5, I don't see rates being cut. And the market selling off is not going to be an impetus for them to cut rates.
So what would cause you to add to stocks? Is it just a sell-off?
No, it would help. Not just the sell-off. That's a good point. Because again, we do use valuation a lot, but we do use the weight of the evidence approach, right? So we'd really look at the macro environment. We look at the trend data. When we look for the current market setup, like where we are, and from where we are with our equity allocation right now, I think a break and hold above the recent trading range was kind of like that 4,200. All else being equal, right? I can only say, if everything stays the same, which it never does, but all else being equal, just to really, rise above that trading range and a hold. Would probably tip the weight of the evidence, all else being equal, and cause us to add to equities. Because again, I do want to say we add to equities because we do still have a decent sized equity position. We're just not at our maximum weight yet. So I think a rise above or a rise below would help us add to equities.
Chris, what happens if the U.S. defaults?
Again, they'd like to scare people. The U.S. really can't default on its debt, right? You can tax its citizens, so it's not going to pay its bills. It's going to pay its dumb. What they can do is have what they call like a technical default. We've done this before by delaying a bond payment. So it's 2 different scenarios. I don't think we're going to default. I don't think we can. We can tax our citizens. It's really that technical default, which may happen. And if that kind of flows through, you can see some borrowing costs rise in the U.S., right? Again, they're not as safe as they once was. That may trickle down to companies that rely on the fact that they're U.S. registered to, decrease their borrowing costs. So those borrowing costs may come up. So maybe a little bit tougher. Maybe companies earn a little bit less money. See some short-term volatility, higher borrowing costs, but very low probability and should not have any long-term ramifications on anything in the marketplace or in the economy by that technical default. And it will get resolved because politicians always do. They wait until the last minute, do everything wrong until they finally get to the right answer, which is to raise the debt limit and actually just pay our bills.
Thanks, Chris. It looks like those are all the questions that we have for now, but if you do happen to think of any, as we were just kind of thinking about all the information that Chris shared with us today, please feel free to give us a call. Our phone number is 978-624-3000. I know Chris would be happy to speak to any of you. Just as a reminder, we are in our new office space as of last week. So that new address is 100 Conifer Hill Drive, Unit 105 in Danvers. For those of you who didn't get our notifications about that, and we look forward to seeing some of you in the office real soon. And Chris, thank you so much for CIO's Corner today. Just as a reminder, we do these quarterly, so you should expect to see just some more announcements as we get closer to review quarter two in, I believe, July or maybe early August. And you can also sign up for that on our website at www.stonehearthcapital.com. Chris, again, thank you so much for taking the time to explain all of this with us. And I hope you all have a great day.
Thank you, Amanda. Thank you, everyone.
Take care. Bye-bye.